And now we have Michał Brzoza-Brzezina from National Bank of Poland and Warsaw School of Economics, presenting the great redistribution that was in the HANK-OLG perspective on monetary policy.
Thank you so much. It's so rare that my surname is pronounced easily and smoothly. This is joint work with Rodolfo Rigato from the European Central Bank, who is sitting there. And since the paper is about the nexus between redistribution, monetary policy, and inflation, let me stress very strongly that these are our own views, neither of the ECB nor of the National Bank of Poland. Okay, let me start by explaining what we do and why we do what we do in particular. And this motivation has kind of two legs. The first one refers to a literature to which, make sure we do not attempt to contribute, we just read it, about optimal monetary policy, the more recent literature, let me call it this way, literature based on models with heterogeneous agent. Because if you go one step back to the old, good, familiar representative agent New Keynesian model, then the prescription for optimal monetary policy is very well known and very simple. Stabilize inflation and stabilize the output gap with if it comes to quantitative measures, then stabilize inflation is the most important goal of the central bank. However, the new of the last, say, 10 years findings based on HANK models say something on the top of this, to make sure on the top of this, which means they say stabilizing inflation and stabilizing the output gap is important, still important, matters, but the central bank should also take into account redistributive effects of macroeconomic shocks. Why is that? That is because macroeconomic shocks can create losers and winners if households are different by, I don't know, age, wealth, labor market status, and so on. It may be the case that losers and winners are more in relative terms. It may be, I will show you an example today, even the case that it's in absolute terms, that a shock that on average is bad will still have some parts of the population, some households, actually leave some households better off. Since agents cannot perfectly insure against such shocks, the additional role of monetary policy becomes to provide at least some insurance against such events. And the picture you have on the slide, it's not from our paper, it's from an excellent paper by Bandari, Evans, Gosov, and Sargent, Econometrica 21, compares the optimal reaction optimal monetary policy reaction to a cost push price markup shock in a representative agent model, that's the dotted line, with the optimal reaction in a HANK model, HANK-type model with heterogeneous agents, that's the solid line. And you see the dotted line, especially on the right-hand side, you can see the reaction of inflation. It's almost flat, so the central bank almost perfectly stabilizes inflation. However, in the HANK model, actually the optimal reaction of inflation is let inflation rise. And even in this particular case, even the central bank actually, on the left picture, lowers interest rates in order to let inflation rise. And the reason, as I said, is exactly the one. This higher inflation gives some insurance to agents, to losers, probably at the cost of winners. So that's the first part of the motivation. The second part of the motivation is more macro history, maybe not so much history, quite recent developments. I mean the developments that happened after COVID, the so-called great inflation period. As probably everybody remembers, inflation started to pick up in early 2021, increased until up to about 10%. That's for the euro area, by the way. While the central bank decided to at least for some time, to accommodate the shock. Of course, monetary policy was tightened at some point, but later. And we think this provides a very nice case to study this nexus about inflation policy and redistribution. When you look like from a a bird's eye view on this picture, then it looks a bit like the ECB reaction closer, just in a qualitative sense, I don't want to go too far on this, to this optimal reaction under HANK, ECB let inflation rise, and under rank where it should be stabilized. But what we want to do in this paper, we want to go deeper under the surface and see whether also under the surface the events were similar to those underlying this optimal monetary policy story from HANK models, which means two particular questions. First of all, were the shocks that hit the euro area, macro shocks I mean, indeed redistributive, and how much? And second, how did the policy accommodation indeed ensure partly, fully, I don't know, agents against the consequences of these shocks? So that's what we do in the paper. How do we do it? We construct, estimate, and simulate a HANK-OLG model. HANK-OLG meaning a life cycle, OLG meaning a life cycle model, HANK meaning a model with idiosyncratic income shocks. You might ask why such a big, some say, monster model, because we want to have in the model main dimensions of heterogeneity, household heterogeneity that are analyzed in the literature to look along different dimensions at what happened. Why do we estimate? Because estimation allows to single out the impact of macroeconomic shocks, even shock by shock, and the impact of monetary policy. That's what we are after. So to be more precise than on the previous slide, the two questions that we ask is, first of all, how did shocks that happened, we concentrated on the 21-22 period, how did macroeconomic shocks that happened over this period redistribute welfare? And whatever I will show you is in terms of model consistent welfare between households. And second, how did the monetary policy reaction affect this process? All right, let me. The model, as I said, it's a monster model. Some say we prefer to think it's big but still beautiful. So let me keep on this slide only for the model overview, and the equations are there. If there are questions, we can go back to the equations, but I hope this slide is sufficient. So as I said, it's a life cycle model with idiosyncratic shocks that generate within cohort heterogeneity. So the typical life cycle model would have all cohorts homogeneous. In our model, as agents face idiosyncratic income shocks, they are also different within each age cohort. Households, and that's the block that is most different from typical small, beautiful model. They enter the economy, some may say, born at age 20. They live for at most 80 periods, and they face age-specific mortality risk. So with some random probability, they die every period. If they are lucky or unlucky, whatever you call it, to arrive at 99, they die with certainty, but it's kind of very small part of the population. And they also face age-specific productivity. And on the top of this, as I said, they face idiosyncratic income shocks that follow a persistent AR1 process. Households work when young, retire when older. When older, they receive pensions from the government. Of course, they consume along their life cycle, and they are allowed to hold two types of assets. That's a kind of typical distinction for two asset HANK models. So liquid and illiquid. You can think of liquid assets. I mean, liquid assets they can access every period. Illiquid assets they can access only upon a friction with some probability. But more importantly, for the results that you will see here is that liquid assets, you can think of them like one period deposits from with a predetermined nominal rate, while illiquid assets are a little bit more complicated, but with a good approximation, you can think of them as claims on, like equity claims on firms, on capital. So much about the household block. As I said, that's the main non-standard part of the model. The production side is a relatively standard one for the new Keynesian literature. So firms produce using capital and labor, face investment adjustment costs. Prices are sticky a la Calvo. By the way, wages are sticky as well. So these are the features that make the model also a business cycle model. Monetary policy is there to act, and it's given by a Taylor rule, and there's a fiscal agent, a government. The government collects taxes, spends on government spending, on pensions, and also on exogenous transfers to households, and can issue debt. That's so. Let me. I hope this is enough, and let me skip the equations and say just a few words about how we calibrate and estimate the model, because both will be there. So the model is calibrated for the euro area. In particular, we do our best to calibrate relatively precisely the life cycle dimension. So both the mortality rates, they are taken exogenously from the data, but also the assets along the life cycle, so liquid and illiquid assets along the life cycle, where we take the data from the household finance and consumption survey. Just to show you one dimension of the calibration. These are liquid and illiquid assets, normalized to 1 for the age 40-50. The dots are from the data. The line is how our model matches this, and I show it for two reasons. First, to show the model. These are largely untargeted moments, so the model does a pretty good job, but more importantly, to give you a glimpse of this heterogeneity in asset holdings and along the life cycle. So people are born at 20, relatively poor, and then they accumulate assets more or less until the retirement age. Then they start slowly to accumulate. And then what we do next is we do a almost proper Bayesian estimation of the model, the type that you do for business cycle, DSG business cycle model. We use 8 data series and 8 macroeconomic shocks. The shocks are monetary policy shocks, price and wage markup shocks, TFP shocks, investment-specific consumption, government spending, and the only one that is maybe a little bit specific to this model is a transfer shock, and estimated, as I said, with Bayesian methods. The biggest difference to a standard DSG type estimation is that the model frequency is annual. The data as a result is annual, which means we have relatively few data points. So we limit the estimation actually to shock processes, standard deviations, autocorrelations. Yeah, full stop. Remaining parameters are calibrated. All right. So having said this, let me move directly to the findings. These are not the final findings yet. That's on the way. So what I show you here is the impact on welfare of macroeconomic shocks that happened in these 21-22 periods as our model sees them, estimated model sees them. So the left picture is along the age dimension. The right picture is along the wealth dimension. The black line is the impact of these shocks on welfare. So either like negative for the young cohorts, positive for the older cohorts, or negative, if you like, for the poor agents, and positive for the rich agents. The decomposition in bars is into shocks, so a relatively trivial type of decomposition given the estimation that we do. But it will help us understand what's going on. So if you look at these bars, there are various colors, but one color definitely stands out as a main driver of redistribution, as the main driver of the main shock that is kind of negative for some agents, positive for other agents, is the dark blue bars. And if you don't see the legend, that's the price markup shock. Okay, so overall from this picture, just for the macro shocks, no monetary policy yet here, we see a pretty strong redistribution from young or poor to rich or old. And the main driver seems to be a price markup shock. So let's try to understand this, why this happens. These are impulse responses to a typical, so we go away from history for a moment, concentrate on the price markup shock for a moment only. So these are impulse responses to a price markup shock. C is a typical supply supply cost push shock, inflation goes up, output goes down. What is more important for our story is actually what happens on the labor market, and you see wages go down and hours work go down, and what happens to returns on assets. And in particular, the main culprit here will be the return on illiquid assets, which drops a little bit on impact, but then rises for several periods. What is the reason? The reason is that increasing markups mean increasing profits, and increasing profits mean increasing dividends mean higher return on these illiquid assets, which I said there are mainly claims on equity. Having said this, let me show you the redistribution that is only due, again, to a price markup shock. So history is away for a moment. This time decomposed into channels that pertain to the household budget. Okay, so first of all, let's see how a price markup shock redistributes. It lowers the welfare, that's positive price markup shock, so positive cost push shock. Lowers the welfare of younger agents, increases the welfare of middle-aged agents, or lowers the welfare of the poorest, and increasing the welfare of the richest. That's the example I mentioned in the very beginning. It's a bad shock on average for the economy, bad shock on average for agents, but there are some agents who actually may gain even from such a bad shock. Why is this? Why are there so differentiated reactions or impact on various households? Well, the red bars in this picture denote the labor market and pensions for the older, but mainly the labor market channel. So the income via the labor market goes down because wages and hours work go down. So those who work suffer. The blue bars in this picture are these illiquid returns. So mainly due to higher profits, and this shape reflects to a large extent our assumptions about how illiquid assets are distributed along the life cycle. Okay, so I hope you understand now why, and you see this shape was reflected in this historical picture, actually just multiplied by the size of shocks that happened, that the model filtered during this period. Okay, so let me now move away from the macro side, and let's go towards monetary policy. So in a moment I will add monetary policy shocks to the picture, but before I do it, let me explain how monetary policy redistributes. These are again impulse responses, and probably don't need much talk about them because they're pretty standard. So it's an expansionary monetary policy shock that I plot here. The interest rate goes down, output goes up, inflation goes up. The labor market is doing better, so the real wages go up, hours worked go up. But one important feature, one additional important feature that will drive redistribution in this picture is this time the return on liquid assets. So liquid assets, as I said, it's like one period deposits whose nominal rate co-moves with the nominal rate of the central bank, and the owners of these assets are in a sense hit twice in real terms. First, because the nominal rate goes down, but second, because inflation goes up. So you hit the real interest rate goes down even twice in a sense, and that's why the return on liquid assets is negative for a number of periods. So you can now more or less imagine what will happen to redistribution after monetary policy shock, expansionary monetary policy shock. But let me anyway guide you through this. So after an expansionary monetary policy shock, again, it's a pretty redistributive shock. Young agents and poor agents, they gain. Older agents, they lose. Why? Well, for the younger, it's mainly labor market income. What puts a drag on the old is to a large extent this income via liquid returns. So they hold the assets, they hold nominal assets, and they lose from holding these assets. One more maybe thing that is apparent here. It's a typical feature of OLG models. This green line, these green bars are about taxes, and you see actually the tax incidence is always, whether it's a positive, like here it's a windfall for the government, or negative if it's lower government income and higher taxes in the future. It pertains more to the young than to the old in a typical OLG fashion, because the old, they discount the future more heavily, and they might just not live until all this windfall is given back to them in the form of lower taxes. So if you want an OLG, extra OLG flavor, that's the one. All right, so let me now go to the main picture of this presentation. So that's our whole story. That's our whole story. So again, I'm back to the 21, 22 shocks. I plot all you have seen already before, so all these channels due to macroeconomic shocks. I also plot now in dashed line the effect of these shocks, the net effect of these shocks on welfare. So that's the line that was a solid line before. But now I also add the effect of monetary policy shock. And not surprisingly, our model filters relatively expansionary monetary policy shocks during this period. And as a result, given what I already told you before, these shocks, and that's the pink. That's the pink. Is it pink? Yeah, it's called pink. Contribution to welfare is positive for the young, positive for the relatively poor, and negative for the middle-aged and older, and negative for the richest part of the population. And the solid line, whether here or here, is the welfare impact on welfare. You might think also in redistribution terms. When everything is accounted for, so macro shocks plus the monetary policy accommodation, if you like. And then you see, whether you look at the left picture by age or right picture by wealth, then this line is much flatter than the one without the monetary policy easing. So in a sense, by being accommodative, the central bank reduced the redistribution of welfare that was due to the macro shock. That's the conclusion that particularly applies to this 21-22 period. If another one, slightly more general, could be drawn, that actually, given how redistributive monetary policy shocks are, which I have shown you before, monetary policy shocks can be used to address distributional concerns. Of course, if the policymaker wishes so, not my role to say this. Almost last but not least, probably last because I'm slowly running out of time, let me stress here something that maybe I haven't stressed yet, that what I have shown does not mean that what happened was optimal from a welfare perspective, because, okay, redistribution was largely reduced, but that comes, of course, at a cost. And what I plot here is counterfactuals for inflation and for GDP growth. Maybe let's concentrate on the left one. So the blue line is what happened, and the orange dashed line is the counterfactual without the monetary accommodation. So had the ECB acted in line with the Taylor rule, responded more strongly to inflation from the very beginning, inflation would have been lower. So it's not this reduction in redistribution is not for free, okay? It comes at a cost of somewhat higher inflation. All right, maybe one more minute. I can try to manage this. So we did one more experiment. I probably don't have time to explain it in detail, but I think it's an interesting one. So what I have shown you so far was mainly about, on the side of monetary policy, was about the ad hoc reaction, monetary policy shocks to what happened. What would ask a question, would it have been different if the ECB followed a different policy rule? So instead of reacting to inflation with a coefficient of 2, which is our baseline, react with a coefficient with a pretty low one, being 1, just the lowest one that provides a solution to the model, or with a high one being 3. And in fact, it is that different policy rules generate different distributional effects after particular shocks. So for instance, you have a TFP shock under these 3 rules on this right-hand picture, upper right corner, and you see that indeed the redistribution is different. So the solid line is the baseline, the upper dotted line is the hawkish policy, and here's the dovish policy. So there are differences after particular shock. But if you take all the shocks together that happen in this period, you have this big picture on the left side. Actually, these things almost perfectly cancel out, saying in particular that the Taylor rule seems to be inadequate to affect redistribution in a systematic way. All right, time to conclude. I have to admit one thing. Everybody uses AI to write papers. That's what I heard. We did it with our own hands and our own brain. So I thought maybe at least for conclusions I can use AI. And I asked Chat, can you give me a picture what this paper is about? And that's what I got. I really like this picture. A bit exaggerated, this dire world without the monetary policy accommodation, in this big and beautiful and shining world with the accommodation. But by the end of the day, I think he or she got the paper more or less right. Thank you so much for attention.
And now we have Bence Bardóczy from Federal Reserve Board to discuss the paper.
Yes, thank you very much for the organizers for inviting me to discuss this paper. It gives me great joy to discuss a paper like this. I'm also involved with the integration of heterogeneous agent models at the central bank. And the usual disclaimer applies. So this paper is about the post-pandemic inflation surge and its monetary accommodation. The authors proposed a really nice cutting-edge OLG HANK model and used that model to filter out the aggregate shocks in this particular episode, post-pandemic, during and immediately post-pandemic, and then use the model to compute the first-order approximation of redistributive effects by age and wealth, which turned out to be very relevant dimensions of heterogeneity for this question. The main results are that it's markup shocks that drive most of the welfare effects during this period through the lens of the model. These shocks redistribute substantially away from young and poor households to old and rich households, and accommodative monetary policy largely offsets this redistribution in welfare space. This is not an ultimate policy paper, but as Michał also alluded to, because redistributive and risk-sharing considerations tend to be very relevant in this class of models relative to just aggregate efficiency, it may suggest that the accommodation was not a bad policy, at least. My discussion will be centered around 3 questions. Are the filtered shocks consistent with the empirical literature on post-pandemic inflation? How are welfare effects determined and disciplined in models like this? And how robust are the conclusions to some alternative modeling assumptions? So initially in the pandemic, we all talked about the supply chain bottlenecks and things like that. But then ex post, I think most of the literature agrees that demand shocks have also played an important role. So one thing that you may be wondering, I definitely have, that the fact that they find this very prominent role of supply shocks or cost push shocks, is it at odds with this empirical view about what shocks actually drove inflation in that period? And the answer is no. In the appendix, there is this figure. It's hard to see. I will just tell you that the purple and the light blue lines are demand shocks for investment and consumption. They are actually quite important for driving spending. But because consumption shocks are actually preference shocks, they end up not mattering so much for welfare. But if you stare long enough, and we don't have that much time to stare at this historical decomposition, I walked away with the conclusion that these are actually very reasonable in light of the empirical literature in terms of maybe 1/3 demand shocks, 2/3 supply shocks, something like that, maybe half and half. But if your objective is welfare analysis, I think you have to be very careful about attributing demand shifts to preference shocks, because they are kind of special when it comes to welfare, because they do have a direct effect on welfare. And we may wonder that We didn't really spend less in 2020 because we wanted to, which what your model would say, partly, but because maybe it's not, maybe of high uncertainty, social distancing restrictions, things like that. Now let's talk about how the welfare effects are actually determined in a model like this. So you have an aggregate shock, and that generates, through general equilibrium transmission channels, changes in aggregate income, both labor and financial. And then to what extent these income changes affect households then depends on the distribution of wealth and the distribution of the exposure to labor income, which in the literature is typically called worker betas. And so that's, if you have a preference shock, that would have a direct impact on top of these potentially observable income effects. And so the first thing that I was curious about is the key thing that allows monetary policy to offset a distribution from markup shocks in the model is that the estimated, on the left you see the model from this paper. The estimated impulse response of hours in particular is almost identical to a monetary policy and a markup shock. And that's kind of crucial for monetary policy to be able to stabilize labor income, which is a main driver, especially for young people of welfare. And of course, a result like that depends on all the modeling details. But I compare the same shocks in our estimated OLG HANK model that we use at the Fed. It's called Frank 2.0. And that has many different features, some similar features, and you get the same result actually. That the hours response is almost identical to monetary policy and the markup shock. So I am for my purposes, that goes pretty far in believing that part. Now, of course, where do markup and monetary policy shocks differ in terms of inflation or impact in particular? Markup shocks are inflationary, contractionary, monetary policy shock is deflationary. And you see that on the return on liquid assets, which is a nominal asset that jumps on impact due to surprise inflation. But that just turns out that in their model and also in ours, it is not as important for welfare as labor income. And then all the other relevant things, like we have return on equity, they have illiquid assets, actually looks remarkably similar to what they find. So again, I think the aggregate first part of the mapping, I think, is very robust. All right, distributions. I don't want to spend too much time on this because but the worker betas are actually very non-uniform across households, in particular by age and income. If you're a young and low-income people, you're about 15 times more exposed to aggregate labor income fluctuations than if you're a middle-aged and high-income person, which of course would matter for the welfare conclusion, specifically from ours. Now, more importantly, if you look at the underlying heterogeneity by cohort in income and wealth, there is a very, very robust pattern, which is that income inequality initially goes up as people age, but then it collapses. But wealth inequality just keeps rising. And this is a feature that obviously matters for how the welfare effects of change in asset prices and interest rates are distributed. And it's actually very hard to get without baking in some kind of non-homotheticity into your model, because otherwise, how could inequality go in wealth keep going up? If income inequality closes, we typically have luxury bequest motives, things like that in the literature, which are absent from this first version of the paper, and they may affect how important inflation is. And this goes back a little bit to Tim's paper too, which I was not asked to discuss. But the average 65-year-old in the US is a millionaire. So having within core heterogeneity can actually make a difference, because of course most of them are not millionaires. All right, but to conclude with a few more detailed comments. Again, this is a beautiful example of using a cutting-edge HANK model to shed light on a policy question that's kind of hard to meaningfully address without heterogeneity. The filtered shocks are broadly consistent in terms of demand and supply split with what several papers have argued. And the aggregate income response is look very similar to an R model, which is different in many ways, including the estimation data, strategy, frequency, etc. Given that, the welfare results, I think, are a very good start, but I have a few suggestions for refinements. Because the welfare results propagate exclusively through income and interest rates, it would make a lot of sense to not just use the standard 7 observable time series that Metz and Wouters have been using and everybody since then, but to actually include as many inputs of the household block as possible among the observables. Now, in my experience, return on equity or illiquid asset in your case tends to be the kind of variable that's hard for new Keynesian models to match because it's very volatile in the data, and having something like a risk premium shock could actually help a lot to get that. And it would be very cheap for you guys to add. And again, worker betas, luxury bequest motive that make most retired people actually relatively poor would make them more exposed to inflation and potentially would make the trade-off sharper. So it's not just about stabilizing output and aggregate employment, but there's maybe more if you go into that distribution. And then finally, you have a very general purpose model, which I think is great because you will be able to use it for many questions. Again, we at the Fed have been using models like this for demographic shocks, a bunch of other things. But because you're focusing on such a specific episode, you may consider specializing the model just a little bit. Again, in particular, going back to this idea that maybe demand shocks are not really preference shocks, but something like high uncertainty, which could be high idiosyncratic uncertainty, mortality risk, social distancing, restrictions on consumption may actually be harder for monetary policy to undo. So we wouldn't have, maybe the story wouldn't be that there was no redistribution. Maybe it helped a lot, but it couldn't quite do as much. Time is up. Thank you very much.
Maybe you can respond now.
Yeah, maybe. Quickly, thanks a lot, Bence, for these excellent comments. Is a lot of food for thought for us, I guess. But let me reply to those issues that where I kind of have a reply. So we deliberately avoided 2020 for the reason I think you are aware of, that this model is probably not very adept to deal with this social distancing measure, etc. Nevertheless, we did a robustness where we use this very model to extend the sample and the simulation to 2020 as well. By construction, the model has to assign some shocks, and it does. It's different shocks that drive a redistribution. The conclusions, the general conclusions about that there would have been redistribution that is much reduced by central bank policy is still there. It's more demand-driven events than in our case. We tried to do a lot to have actually demand play a role. So, for instance, the maybe unusual variable in the estimation, which is transfers, we added in order to have this. Actually, they prove very unimportant in the redistributions, to a little bit our surprise. Maybe if we had the kind of targeted transfers targeted towards the poor, then it would be stronger. But first of all, the beauty of the euro area is that you have one monetary policy, but what's the opposite of beauty, whatever? The non-beauty of the euro area modeling is that you have like 20 fiscal policies, 20 COVID policies, etc., 20 transfers policies, and it's super hard to get the data and to calibrate this in a more precise way, as, for instance, people in the US are able to just do from the legislation on the CARES Act. Yes. About this this rising wealth for the older, I think actually our model doesn't do well here. I mean, it's on the one hand, we don't have much data on this, so the data from the HFCS stops somewhere around 70. So what we know about the development of wealth for older agents is more for the US SCF, for instance, that it really does not decline so strongly. It declines in the model by construction. We don't have warm glow motive for bequests. Maybe we should think about it, or maybe we should just cut cut the pictures at around 80 because the size of the population that is older than this is relatively small anyway. So maybe that's a reasonable thing to do.
Okay, maybe we can, Michael.
Michael McMahon, University of Oxford. I have two related comments, and they build on what you were just saying. I think we shouldn't forget the role of fiscal in all of this. In particular, it's very flexible, lots of levers. If you think there are 20 fiscal policies, within each fiscal policy in Europe, there are hundreds of instruments and the levels of targeting. So I think we should always be incredibly careful before suggesting that a blunt tool like monetary policy should ever be used for redistribution when we have incredibly flexible tools on the other side of the house. But where I think your model, and not at the risk of making it more complex, I think you've got a wonderful model, and the world of monetary and fiscal interactions is so trendy and sexy right now that you can really answer some questions there. You started to allude to it there about the role of transfers, but I think thinking about what's the optimal policy, what's the optimal way to actually address some of these price shocks, and these are rearing their heads again, so it's particularly pertinent as well. Thanks.
Leo and Guido then, and then we go to the other side.
Leo von Taden. Let me just say what the previous speaker said, Michael. I fully agree with this. I find it very difficult really to get the main message of the model without having been told really anything about fiscal policy. And there's a danger to this because the way I see the mechanism in the model, right? And I trust that all this is absolutely correctly calculated. But the danger is, we achieve all this through a spike in a surprise inflation. So this means it takes away space when the next crisis comes for the central bank to act. And this is exactly a problem that we face now. We are hit by a severe supply shock. Textbook, recommendation is to look through it. But what we have in the history is this inflation surge. And somehow my feeling is it would have been better to motivate this first through in particular when we talk about the euro area, even more worrisome here, through, why should we think that fiscal policy is unable to do its primary task, which is to get kind of the distributional thing straight? And then secondly, if monetary policy nevertheless has to step in, what does it mean for inflation expectations and for the credibility of the central bank? This is the way I read our mandate.
So Guido, and then we go to,
Guido Ascari, just very quickly, so you have an application to the recent inflation surge. One of the debate there at a certain point was the strong increase in profits that you can look at the GDP deflator, that gave rise to the so-called greedflation debate, which I don't want to talk about. But so that's your model can speak to that, because my understanding is that actually most of the redistribution goes actually through the stock market. Through the illiquid returns.
Thank you. So very interesting. First of all, going to the price markup shock, you show that it leads to a decline in hours and wages. And then my question is the decline because of the markup shock or because of the monetary policy response to it? Because usually with a markup shock, it's not the markup shock itself that is contractionary, but it's the monetary policy response to it. So it would be nice to see the response holding monetary policy constant, so not reacting to that markup shock endogenously. Then the second thing is that you show these very huge accommodative monetary policy shocks. I'm not 100% convinced by them. So the question is, do you have a time-varying R star in your model? If you don't have, and you estimate the model, typically the R star that is estimated in the model is very high. And what this then does is that when you have a period of very low interest rate after the great financial crisis, you have these extremely large accommodative monetary policy shocks that probably play a role here as well. And if you correct for it by having a time-varying R-star, I don't think that you will have those shocks. So then, putting everything together, I would rather just clean out the monetary policy shocks in the first place, make sure you have a proper measure of monetary policy in the model, and then maybe, as Aro suggested as well, do optimal policy also in response to this. Thanks a lot.
Davide and Martin. Yeah.
Well, I have time to reply.
Thanks. Davide De Bortoli, Università Pompeu Fabra. I have two questions. The first one is related to one of the discussant comments, that is, you identify cost push shocks, but in this class of models, sometimes it is difficult to separate from labor supply shocks from an empirical point of view, but they will have very different welfare implications. Unless you, so one way to do it is to take into account unemployment that allows you to separate labor supply from other, cost push shocks. The second comment is more broadly related. Well, this is the second paper showing that if you have today we have tensions in the Middle East with oil price pressures combined with loose monetary policy. This could be great. Aggregate economic activity goes up. Many people will see a raise in welfare that is about equivalent to a 10% rise in consumption. Should we, are we endorsing this type of policies? Second, if not, who is going to lose?
And Martin as the last one, yeah?
So it's just in response to the comments on transfers. So I think you can use probably your framework, and just this is the beauty of the euro area, that you could abstract it to looking at a small open economy within the euro area, take monetary policy more or less as given from the outside, sort of read in sort of data from the euro area as a driver for export demand. For that small country, and then you can be more detailed on the transfers, actually, to elucidate a little bit more on the effects of those. I mean, then of course you lose a little bit the richness of speaking about the whole euro area, but at least you can study then for a specific country what is the role of these various shocks.
Yeah. So,
in minus 1 minute
exactly,
to respond,
yeah,
and I stand between you and lunch. So let me first thanks for all the comments. Most of them I just take as food for thought for what we plan to do in the future. It would be a waste, definitely a waste of having a model and not using it for monetary fiscal interactions. we think about something, definitely. Maybe one by David, because I think that's a pretty important one about second oil shock. In a sense, the question, and that goes much beyond the model, but we have to think about this: how many times can you look through oil shocks in a row until inflation expectations get just unanchored? I mean, the model has nothing to say about this. So the model, and this is conditional on the fact that inflation expectations were assumed to be anchored, and ultimately probably were, but whether this is for the second time, no idea. About the R-star corrections, I'm very sympathetic for R-stars. I wrote my PhD thesis many years ago about R-star, and I'm pretty sure it moves around. I do not think it moves around as much as would be necessary to undo the monetary policy shocks here in a really significant way, even if reducing the effects somewhat. And maybe the last one I can handle quickly by the comment, because it's an important comment by Guido about the profits. We are also worried that it's about profits that might have partly simply gone abroad, because the oil price shocks in this period, and part of the profits were probably to the Middle East and not to the local capital owner. So we did a robustness check where we wipe out a large part of the profits. Still, the results are a little bit weaker, but they still hold, mainly because most of the redistribution is actually via the labor market here, and profits play a smaller role. So even if you wipe out half of the profits, it is still there. Can I continue?
I think we are good.
Maybe we are good, and maybe
Yeah.
I'll be happy to talk to you later. Thank you.